Good afternoon, everybody. For those of you who don't know me, I'm Alan Blinder. Ex-everything except professor at Princeton, which I still am. At my age, you're ex more things than you actually are. It is our collective honor, Princeton and the Rabinowitz Center and the Griswold Center, to welcome here to speak to us today Dr. Adriana Kugler, a member of the Board of Governors of the Federal Reserve System. And in return for that, I promised not to ask her about the next FOMC meeting. So thank you for coming. Adriana became a member of the board in September 2023, filling out a term. As those of you who know the Fed know, and those of you who don't probably don't know, all Fed terms end January 31st. So to fill out an unexpired term, which lasts till January 31st, 2006. Becoming, by dint of that, the first member of the board of Hispanic origins, which is kind of amazing when you think of it. The Federal Reserve started in 1914. It's been a long time, and good that we have you on the board. Prior to that, Adriana was serving as the U.S. Executive Director at the World Bank. Her regular job, so to speak, when she's at the regular job, I'm going to mention something else in a minute, is as a professor at Georgetown, where I note that in addition to being a professor of public policy and economics, which I understand, was the vice provost at Georgetown for faculty, which sounds to me like a euphemism for herding cats, which you don't have to do in your current job. Prior to that, as I said, she was the chief economist at the U.S. Department of Labor from 2011 to 2013. She's a research associate of the National Bureau of Economic Research and the Center for the Study of Poverty and Inequality at Stanford, and a whole bunch of other things that I'm not going to take our precious time to read to you, other than to note that she has a BA in Economics and Political Science from McGill in Canada. We all know about Canada now. And a PhD in Economics from the University of California at Berkeley. Sadly, no Princeton degrees, but we're definitely not holding that against you. Thank you for coming here. And as you can see from the title, she's going to speak to us about inflationary expectations. The floor is yours.
Thank you so much. Well, thank you so much, Alan, for that generous introduction. And thank you to the Griswold and Julis-Rabinowitz Centers for the opportunity to speak to you today. As someone who has worked on both the public sector and academia, I certainly applaud the common purpose of both centers in connecting researchers, policymakers, and the private sector to get a common purpose on policy ideas that serve the public good. To that end, I think there are few, very, very few individuals who have done more as a teacher, as a researcher, as a government official, and certainly as a public figure than Alan Blinder. That includes educating the public. In the spring of 22, as many wondered whether the Russian invasion of Ukraine would add to the factors that already were driving up inflation, Professor Blinder wrote in the Wall Street Journal that a more important factor would probably be the public's expectation of future inflation. And as I will relate today in my remarks, he was, of course, absolutely right. As in the past, inflation expectations have played a crucial role in the course of inflation since the spring of 22, and I expect they will be an important factor in the Federal Reserve's ongoing effort to achieve sustainable inflation of 2%. For that reason, I would like to focus on inflation expectations today before discussing my outlook for the US economy and the implications for appropriate monetary policy. First, I will describe inflation expectations within the conceptual framework that many economists use to connect inflation with the broader economic activity known as the Phillips curve. Second, I will discuss the central importance of the stability of these expectations, which have come to be known as the anchor of inflation expectations. And third, I will explain how firms and households as well form their inflation expectations and how these expectations affect economic decision making. Throughout, I will make some references to historical experiences in inflation, but I will certainly focus on the period since the pandemic. Economists have long recognized the connection between inflation and overall macroeconomic conditions, but it was in trying to explain this empirical relationship that the importance of inflation expectations was actually revealed. The foundation of this work was laid by New Zealand economist A.W. Phillips, a fascinating figure who was, among other things, a mechanical genius who built an early economic model operating by hydraulics rather than electronics. In contemplating the mechanics of the economy, in 1958, Phillips set about to explain why nominal wage growth was slower when unemployment was higher and faster when unemployment was low. His and other subsequent research showed that a crucial factor was the utilization of resources, such as labor and capital. Generally, when firms use labor and capital very intensively, production costs tend to rise, and firms have more scope to pass those cost increases as higher prices, which in turn pushes up inflation across the economy. In contrast, when the level of utilization is low, costs tend to rise more slowly or even fall, and firms have less scope for raising prices and thus pushing down inflation. This trade-off has been known as the Phillips curve. In this simple form, this trade-off implies that governments can achieve and maintain very low unemployment only if they allow inflation to rise above a certain level. In the latter 1960s, Milton Friedman and Edmund Phelps asserted that this orderly trade-off was only temporary and would ultimately, note the word temporary, and would ultimately break down because of the role of expectations, and in particular, inflation expectations. To use an example, while current production costs are important to factory owners setting prices, the owner will also consider future production costs, future levels of demand, and expectations for inflation throughout the economy. Likewise, workers will factor expectations of future economic conditions into their pay demands. And banks will consider future inflation in deciding loan rates. Consumers, whose purchases constitute some 2/3 of economic activity, make decisions about whether to purchase something today with an idea of what it will cost in the future. All these decisions are influenced by expectations. And this is the way in which expectations may shape inflation today. In turn, when we think about the Phillips curve and its trade-off nowadays, we account for the importance of expectations of different individuals throughout the economy. There are different measures of inflation expectations. Some come from surveys polling business owners, others from consumers, and yet others estimating expectations among bond investors based on the differences in yields between nominal and inflation index securities. While most of my points today apply broadly to all of the measures of expectations I mentioned, my examples will come mainly from surveys of consumers and businesses. While there are questions which I will address about how well these surveys measure inflation expectations, I really closely monitor all of these measures because they complement market-based indicators of future inflation that are affected by dynamics intrinsic to financial markets, such as changes in risk premium. Let me note that in addition to the way expectations of future inflation influence prices in the near term, there are economic mechanisms that link current inflation with past inflation, such as those that set wages and the terms of rental contracts. It's from the White House telling me about the tariffs. So. It's an important call.
Tariff rate is on Costa Rica exports. Sorry.
No worries. Let me note that in addition to the way expectations of future inflation influence prices in the near term, as I was saying, there are economic mechanisms that link current inflation with past inflation, such as those that set wages and the terms of rental contracts. So in these cases, adjustments in these terms are often benchmarked on past inflation, as for example, when workers and landlords aim to recoup losses from increases in general prices. So to cite one example, as the economy reopened after the pandemic, workers sought higher wages to compensate for the earlier wave of inflation in food and core goods, thus pushing up inflation, especially in the services sector, where labor accounts for the largest share of the costs in this sector. And because rental agreements typically last 12 months or more, as you know, these yearly rentals that one gets, landlords faced a lag in adjusting rents to reflect the escalation of inflation after the pandemic and sought to recoup also those losses when renewing leases. By looking at price changes in this way, in the rearview mirror, some decision makers in the economy end up making inflation more persistent. That is important for me to consider as an economic policy maker because I must pay attention both to expectations of future inflation as well as persistence of current inflation. When we speak of expectations of future inflation, it is crucial to define the time horizon. And different surveys conducted by the Federal Reserve and others ask about inflation all the way from 1 year to as many as 10 years. Surveys with a shorter horizon, such as the Michigan Surveys of Consumers Question on Inflation 1 year ahead, are heavily influenced by current inflation. Near-term inflation expectations tend to be volatile. They move up and down when, for example, energy prices increase, or down when energy or some other volatile set of prices also decreases. These expectations are important because many economic decisions, such as major consumer purchases and hiring and investment as well for firms, focus on horizons of only a few years ahead. By contrast, inflation expectations over longer horizons, such as the Michigan Survey's question on inflation between 5 and 10 years ahead, say less about current conditions than about the trend for inflation for some time in the future. You can think about these longer-term expectations as much less affected by forces that push inflation up or down in the short term, or what we economists call shocks. Longer-term inflation expectations tend to be less volatile, affected less, for example, by what oil or food prices may have done lately, and more by the stability of inflation over several years or even decades ahead. I mentioned these different time horizons because they matter in my job as a central banker. Expectations a year from now reflect short-term shocks in the economy, as well as ongoing efforts from monetary policymakers to bring the economy back to the longer run state. Thus, while short-term expectations may indicate whether inflation is expected to move towards its target, they're not the best gauge of monetary policy credibility. So keep that in mind when I mention some of those measures later on. Longer-term inflation expectations, on the other hand, should be much less influenced by short-term shocks to the economy, and a change in those expectations has implications for the Federal Reserve's prospects for meeting its price stability goal. When these longer-term expectations are reasonably low and unresponsive to short-term developments, we say they're anchored. It is not clear who first coined this term, but Federal Reserve Chair Ben Bernanke in 2007 gave a speech on inflation expectations in which he described anchored inflation as relatively insensitive to incoming data. So, how should we think about the process of anchoring and de-anchoring of inflation expectations? The dynamics of short and long-term inflation expectations shed light on this issue. If the public experiences a spell of inflation higher than their shorter run expectations, it will revise up the shorter run expectations to ensure that their near-term plans account for the changing economic environment. That's what happened after the pandemic, when inflation based on personal consumption expenditures rose to a peak of 7.2%, and one-year expectations rose to more than 5%. But longer-term inflation expectations remain very well anchored, with values ranging along those seen and observed since 1995. I would contrast this experience with the previous bout of high inflation in the US from the 1970s to the early 1980s. Among other issues, such as high energy prices and accommodative monetary policy, rising inflation and inflation expectations fed a cycle of escalating inflationary pressures. Inflation was high and very volatile over this period, and that is reflected in the shorter and longer term inflation expectations that were also high and volatile during that period. Another important difference between these two episodes has to do with the performance of the Federal Reserve. As opposed to the late 1960s and most of the 70s, most recently, the Fed acted aggressively to tighten monetary policy, raising the federal funds rate more rapidly than in previous tightenings, and lowering inflation also more quickly than ever before. This came after 30 years of success in keeping inflation in check, and the credibility earned by the Fed's inflation discipline surely helped keeping long-term expectations stable. And two people here contributed to that. This shows that an important role of the central bank is to convince the public through actions and communications about its intention to shape economic conditions and to use its policy tools to bring inflation back to its target. By committing to keep inflation low in the future, central banks seek to influence expectations of future inflation, which in turn influence conditions now and also over time. The Fed's credibility in keeping inflation low and stable won over many decades, kept longer-term inflation expectations stable, and that contributed significantly to the Fed's success in reducing inflation while keeping the labor market also strong. Those are some of the basics about inflation expectations and how they influence the economy and the conduct of monetary policy. So next, let me turn to what I want to see about the patterns we see in the survey measures of inflation expectations, what influences expectations, and how inflation expectations are used by the public in their decision making. Fortunately, there is a rich body of economic research that has shed light in some of these questions, and I will focus on the evidence for households and for firms. We can then take care of some lessons from these empirical patterns for monetary policy making. So, one important observation is that both short and long-term inflation expectations are often notably higher than actual inflation, even after a period of very low inflation. That is, there is evidence that survey respondents often believe the inflation they have experienced is higher than it actually is. Another pattern is that there is a wide dispersion of views about both short-term and longer-term inflation expectations, reflecting obviously, at least in part, the dispersion of inflation in the consumer baskets of goods and services that are purchased by different people. Research also finds that some groups, such as women and lower-income households, tend to have systematically higher inflation expectations. In addition to these variations in expectations, there is high uncertainty in forecasts of future inflation. When people are asked to assign probabilities to different forecasts of inflation, surveys report wide distributions in the likelihood of one versus another outcome. Finally, short-term inflation expectations tend to be correlated with both recently realized inflation as well as perceptions about recent inflation. These patterns tell policymakers that inflation expectations of households and firms are diffuse and likely harder to influence through monetary policy relative, say, to financial market participants and professional forecasters who follow news more closely. Still, expectations from business owners and workers ultimately inform firms' pricing decisions and costs, and may even be more relevant for inflation outcomes, and thus it is very important for policymakers to communicate clearly with the public about our intentions to bring inflation back to our target. So, because inflation expectations are diffuse and heavily influenced by recent experience, let's consider now the reasons for the dispersion in these expectations. Unsurprisingly, it starts with the considerable variation in the sources that the public uses to collect information about inflation. Households report that their main source of information are their own shopping experiences, including regular purchases such as groceries and gasoline, and these price changes in those goods and services are what affect inflation expectations. Also, it seems like inflation expectations of homeowners tend to respond to changes in mortgage rates because homeowners have more of an incentive to track changes in rates that might affect, for example, their prospects for loan refinancing. Another important source of information is energy bills, with evidence also pointing to household inflation expectations being more sensitive to energy prices when inflation is higher. More generally, consumers and firms seem to pay more attention to news related to inflation when inflation is high, and this has been found as well in many other countries. While the unique experiences of survey respondents matter, this evidence points to inflation expectations being dependent on the state of the economy. Thus, we, policymakers, should account for different economic conditions when assessing the risks of a de-anchoring of inflation expectations. For instance, with fresh memories of the post-pandemic inflation and with recent surges in prices of some food items regularly purchased, inflation expectations of workers and firms may now be more sensitive to anticipated future price increases relative to the pre-pandemic period. Let me now turn to how households and businesses employ their inflation expectations in their economic decision making, with much of the evidence consistent with what would be expected given long-standing economic theory. which is good for us economists to know. Starting with households, in addition to any influence on wages from past inflation, expectations of future inflation help shape demands for pay raises. Workers care about their inflation-adjusted wages rather than nominal wages, and we see a positive correlation between inflation expectations from consumers and wage growth, with a close commitment during the recent inflationary battle. A complementary decision for the worker is to look for a new job that pays more, especially if the person envisions a low probability of getting a raise in the current job, or the raise will likely not fully cover losses in real incomes from inflation. Indeed, measures of general wage growth are more sluggish relative to those of job switchers. Moreover, researchers also find evidence of higher job-to-job transitions for workers who have higher inflation expectations. So inflation expectations of workers are an important influence on nominal wage growth and an important indicator of inflationary pressures for us policymakers, especially in terms of services inflation. Now, let's consider how these expectations influence firms' decision-making. As I discussed in the context of the Phillips curve, firms with higher inflation expectations would be expected to increase prices more, and indeed, researchers find causal evidence of this. During the recent period of high inflation, the fact that business owners' short-term expectations about costs or input prices rose only modestly and soon returned to levels close to 2% may suggest that firms' inflation expectations may not have been a strong source of inflationary pressures. Still, researchers at the Richmond Fed also found that during this period, business leaders incorporated more information about aggregate inflation measures in their own pricing decisions compared to times before the pandemic inflation surge. While researchers also find that business leaders pay less attention to inflation as it came down, this evidence points to the inflation expectations of businesses being insensitive to underlying inflationary dynamics, and monetary policymakers should certainly remain attentive to this. And I'll turn back to this in a minute. Now, let me turn to the recent developments in inflation expectations, the current U.S. economic outlook, and their implications for monetary policy. In recent months, we have seen several measures of inflation expectations increase, with both consumers and businesses reporting new and proposed tariffs as an important reason. So the word of the day, tariffs. Among surveys looking 1 year ahead, there have been notable increases in the Michigan surveys of consumers, the Conference Board survey of consumers, the Atlanta Fed survey of businesses, the Philly Fed survey of professional forecasters, and the New York Fed consumer survey. For instance, this past Friday's release of longer-term inflation expectations from the Michigan survey was the highest since February of 1993. Additionally, the recent spike in short-term inflation expectations appear to be mostly anticipatory, as one can infer from the divergence between falling inflation perceptions, what consumers think price increases have been in the past year, and climbing short-run inflation expectations. This anticipatory nature of the recent increase in short-run expectations may allow for price pressures through a second channel. That is, businesses may feel a greater ability to pass along higher costs to consumers when they come from external factors out of their own control. Indeed, firms are already reporting not only higher costs, but also expectations of higher costs according to some surveys, such as the one conducted by the Atlanta Fed, along with other manufacturing services as well. For now, I take some comfort from the much smaller increases in longer-term expectations as measured by the Philly Fed Survey of Professional Forecasters, as well as the stability of longer-term measures on what we call inflation compensation, which is based on yields from nominal and inflation indexed treasury securities. As in past episodes, when inflation expectations increased, uncertainty about future inflation seems to have also gone up as measured by the disagreement between the 75th and 25th percentiles of the distribution of individual respondents from the Michigan survey. Simultaneously, in recent months, we have also seen measures of economic policy uncertainty increase, and there is evidence that policy uncertainty and inflation uncertainty correlate with each other. One possibility is that policy uncertainty may be contributing to the rise in inflation expectations, as well as to uncertainty about future inflation. Still, it is hard to say at this point, and I will certainly keep monitoring these developments very closely. So, let me now turn from developments on expected inflation to realized inflation. After the substantial decline in inflation from its peak in 2022, recent disinflation has been slower, and the latest data indicates that progress towards the FOMC's 2% goal may have actually stalled. Core PCE inflation was 2.8% in the 12 months ending in February, which puts us back at the same level as we saw in the last quarter of 2024. The best news from February came from housing services inflation, which has come down steadily for at least a year to a 12-month rate of 4.3%, coming down from 8.3% in April of 2023, but it's still quite a bit above what it was pre-pandemic at 2.5%. For the rest of the inflation categories, the news has been less positive. Core goods inflation, which had been negative for most of 2024, increased to 0.4% relative to a year before. February likely also marked an upward shift in market-based services inflation. While I do not discount price pressures in non-market services, which do remain elevated, upwards of 5%, the acceleration in market-based services in February from an estimated 3.1% to 3.5% is also not welcome, given that this category often provides a better signal of inflationary pressures across all services. On the other side of the FOMC's dual mandate, employment continues to grow at a moderate pace, and the overall labor market has remained resilient through February. The net 151,000 jobs added last month was not too far from the 177,000 average of the previous 6 months. And while the unemployment rate ticked up to 4.1% and labor force participation moved down to 62.4%, other labor market indicators suggest continued moderation in the labor market, but not significant weakening. Given the recent lack of progress on inflation, recent increases in inflation expectations, and upside risks associated with announced and prospective policy changes, I strongly supported the FOMC's decision at our March meeting to maintain the target range for the federal funds rate at 4.25% to 4.5%. I will support maintaining the current policy rate for as long as these upside risks to inflation continue, while economic activity and employment remain stable. Going forward, as always, I will continue to carefully assess incoming data, the evolving outlook, and any changes as we speak to the balance of risks that we face. So thank you very much.
So thank you for the very interesting talk, and especially for the reminder, which a lot of us professional economists need, that expected inflation is not just one symbol in an equation, implying by dint of that it's the same for everybody.
Right?
That it's not the same for everybody, and that it moves for a variety of reasons which are also not the same for everybody. I mean, it's a thought that probably we should have more in our economic modeling than we actually did. So thank you for that. And in line with that, I want to ask you about a group that you didn't mention, people on the Federal Reserve, who don't always have the same expectation. And in particular, to sharpen the question just slightly, you started your talk by going back to Phillips, the Phillips curve. Many of us, I'll include myself in this, but it's not an idiosyncratic view, think the Phillips curve kind of disappeared from the face of the earth with the turn of the century or about that. So the question, you don't have to agree or disagree with that. Well, you may if you wish to. But the question is about forecasting without a reliable Phillips curve. Because the Federal Reserve is forced to forecast expected inflation to do monetary policy.
So yeah, that's something that some have questioned. I have to say, as you know, back in 2016, Chair Yellen actually gave a speech on the expanded Phillips curve, and I just literally a few weeks ago at the Whittington lecture at Georgetown, where I'm on leave from, I gave a lecture on an expanded Phillips curve that includes the V to U ratio, the vacancies to unemployment ratio instead of the unemployment gap. That includes also supply side disruptions and supply side uncertainty. And that seemed to perform actually quite well. And honestly, the staff at the Fed does a really good job working on this expanded Phillips curve, which actually seems to work quite well. Now, you may be on the steep part of the Phillips curve, you may be on the flatter part. It's not uniform. This relationship does change over time, and as you know, between the two recessions, that Phillips curve seemed to be flatter. Now we seem to have been on the steeper part, but I think it works, and I think, used appropriately and expanded in the right way with the right data, it actually tells us something about the relationship between inflation and unemployment, or slack. As I said, I replaced the unemployment gap with the V to U ratio, and that measure of slack seems to perform a lot better.
You feel it's a tolerable, not there's no perfect forecaster, but it's a tolerable, in the sense of usable tool for forecasting inflation.
Absolutely. It is informational. Yeah.
On the difference, you emphasize at several points the difference between the Michigan survey, which is of ordinary people, and the market expectation from the implied break-even rate from the TIPS market. Lately, they're very different.
Mm-hmm.
I wonder if you would say something about what you think is behind that difference, and in particular, is some of it tariffs, to use the T word again, which you used before. I'm thinking in terms of the ordinary people that asked about in Michigan, that no tariffs are coming.
Yeah, it's very interesting to see the responses to these surveys, both from consumers but also from businesses in these surveys that are not prompted, they're volunteer answers. And about 50% of those in the Michigan survey said that this higher expectation of inflation came from tariffs. in the business surveys as well, the ISM surveys, for example, the Institute of Supply Management, or the Dallas Fed survey of businesses as well, they also prompt this answer about this potential increase in prices moving forward being related to tariffs. So that comes across in a range of surveys, not one but several, and it comes without the survey. The survey is actually prompting for this answer, but it's volunteered information by those who participate in the survey. So it seems to be related to what may be coming. That's why I said there seems to be an anticipatory reaction. But by the same token, if you look at the ISM, for example, the ISM, especially the manufacturing survey, that showed that there are increases in costs already. So input prices, material prices, right? Those are already being felt by many businesses, and that's in itself increasing prices. The other part may be anticipatory.
So why aren't Wall Street traders reflecting that in the tips market?
I think there are many, as I mentioned in my speech, I think there are many other factors that may affect the pricing of securities and risk premia, and they may be thinking even farther ahead to what may be coming in terms of economic growth. So that, I mean, there are different factors that affect the two measures.
So there's a broader phenomenon of which this may be a case, which is, and people talk about it more on the real side of the economy than on the inflation side, but I think this is an example where it's on the inflation side, which is that developments are showing up in what is often called soft data. A lot of it is surveys, you know this, but without showing up in hard data. The inflation rate is an example of that. And you mentioned that correctly, that inflation has kind of leveled off. It has not gone up, unless you want to count 1/10 or something like that. But there's an expectation shown in some of the survey data that it will go up. And you see a lot of this in surveys of future real economic activity. So I'm wondering how you square that as a forecaster.
So yeah, I know people like to talk about soft data and hard data. I myself like to talk about traditional and non-traditional data. I don't think of it as necessarily being soft. And I gave a speech about it less than a year ago at NABE, at the National Association of Business Economists, talking about these two sources of data, which I use all the way. I count on the official data, the traditional data, which usually is available at a much lower frequency, and it's usually highly vetted, it tends to be representative, and then non-traditional data, on the other hand, tends to come from businesses, from the private sector, from users. It's unlikely to be representative, but it's usually available in real time, and it's usually available at a much higher frequency, which is why I like to use it as well, because we know what's happening today, not what happened 1 month ago or 1 quarter ago, or even sometimes 1 year ago when you count on these traditional data. So I like to use them combined. In terms of prices, I have to say that that's one area where the two coincide. So you're hearing from these manufacturing surveys, right, the PMI, you're already seeing that purchases are more costly, right? Costs are already going up. They're already charging higher prices. And then in the official data, it's true that overall, right, the headline, the core, you may not see that yet, but goods inflation, on the other hand, really went up. It actually used to be minus 0.4 a year ago. It's now 0.4%. So it has substantially changed. And again, I mentioned market-based services inflation. That's another area where we're starting to see a reversal. So I'm paying attention to both the soft data and the hard data. I agree with you. There are other areas where we don't know as much. For example, in terms of real activity, right? Real activity, we get these non-traditional data on retail sales. We had seen a bit of a softening, a slowdown. And yet, for example, last night, in fact, we got data on auto sales. And that showed a spike. Again, likely anticipatory to those tariffs that were announced today, right, of 25%. So people rushed to the showrooms, went and got their cars before facing that. And so it could be that by the time we get our first quarter GDP data, we're gonna see a combination of these two. Some front loading, but then some maybe right a little bit of a reflection of this caution from both households and firms in terms of investment, in terms of consumption, because of the uncertainty, because of what may be coming ahead. So that I think is harder to read, at least at this point, and harder to make out clearly a way in which the non-traditional data can tell us about what we're likely to see for the first quarter. Most likely some softening relative to 2.5% back at the end of last year, but how soft, given that you also see the front loading by some households is less clear.
You emphasize the advantage of the non-traditional, that you get data sooner.
Absolutely,
But
real
there's
time.
presumably a trade-off between accuracy and speed?
Absolutely, that's exactly right, Alan. And the other thing is, with some of these non-traditional data, you don't have the historical trends, right? You
Right.
cannot compare all the
Right.
way back, seeing how things behave back
That's right.
then. So there is certainly a trade-off, yeah.
I want to shift gears only slightly to the coming or already here supply shocks that we're getting from tariff policy and immigration, which is affecting the labor force, as you well know better than most. A lot of the underlying growth in the last couple of years on the supply side of the economy, potential GDP, has come from immigration, both legal and illegal immigration. That's almost certainly going to slow down quite a bit. Probably already has. There are data lags. The tariffs are going way higher. I didn't hear what our dear president had to say in the last few minutes, but at last check, he was going above McKinley and above Smoot and Hawley in tariffs. So these are both potentially sizable supply shocks, stagflationary shocks, when you put them together. There has developed over the years calling it a tradition is a little too strong, but something like that, of central banks supposed to look through supply shocks on the grounds that these are things that happen to you, unhappily often, and then go away. And so you don't want to react by tightening monetary policy just in time for the go away, and you cause a deeper slump than is necessary. I'm wondering how you're thinking about this received wisdom of a central banker should look through supply shocks and applying it to what's going on prospectively very soon.
Thank you for that question. Yeah, let me take a step back. Of course, as you know, this administration has talked about tariffs, about immigration, but also about regulatory changes and fiscal policy. So just to be clear, we don't have purview under any of these policies, and we don't comment on the policies themselves.
Sure.
What I do all the time, certainly, is to consider how those policies around us affect our dual mandate, right? Price stability and maximum employment. And as you noted, there are several ways in which certainly some of these policies may affect our dual mandate. So you're right, the theory says that, the reality may be very different. There may be reasons why tariffs may have more prolonged effects. And let me just cite a few. So one of them is that some of these tariffs that are already in place, I'm talking about the ones already in place, including the ones on aluminum and steel, are tariffs on intermediate goods. And these tariffs on intermediate goods, so take for example, steel, right? That affects the auto sector. Aluminum affects transportation, logistics, packaging. It affects almost every sector. So these will affect all sectors through supply chain networks. So that means it may just take longer for that to filter through the economy. The second reason, and we have been seeing this already, why the effect of tariffs may be more prolonged is that they have been announced in a slow fashion, right? They're coming kind of one at a time. We still may have more to come. There may be retaliatory dynamics starting to play in that would also extend and prolong the impact of those tariffs. The third reason is expectations, inflation expectations, which I mentioned. So if this really starts affecting not only the short-term inflation expectations, which we already are seeing, but also long-term expectations, and then it could have a more prolonged effect. And last, right, there is the effect potentially on the reallocation in the economy and potentially misallocation in the economy in terms of economic activity. And so the movement towards production in sectors in which maybe we don't necessarily have a comparative advantage, and that will mean we're paying higher prices for things that could have been produced more cheaply somewhere else. So because of those factors, I don't think it's as simple as the theory suggests. We economists have to pay attention to the realities on the ground too, not only the theory. And the reality is that it could just make the effect last longer if some of these factors play.
I'd rate that a good answer. Thank you.
Thank you. Thank you, Professor.
One professor to another. We're going to open to questions from the floor. Just two things. Identify yourself so we know who you are. And make it a question, not a speech, please.
So,
Bill,
I was wondering, Bill Dudley, Princeton University. I was wondering if you could talk about the sacrifice ratio, because I think one of the...
Sorry, Bill.
You're fading in and out.
Let me just try to turn it on.
So I wanted to ask you about the sacrifice ratio, because one of the big debates early in the pandemic was how much was it going to cost in terms of higher unemployment to get the inflation rate back down to the Fed's 2% objective. And we actually found out that the sacrifice ratio was really low, presumably because inflation expectations stayed well anchored. So that the lesson seems to be from that you really don't want to take a lot of risk in letting inflation expectations become an anchor, because if you do, the cost of getting inflation's expectations re-anchored is going to be very, very high. How does that weigh into the Fed's thinking?
Sorry about the microphone.
Yeah.
Princeton had a bad endowment year.
Research grants for
You can hear the question.
Okay, yes, absolutely. Thank you, Bill, so much for that very important question. So as you pointed out, the inflation, headline inflation came from 7.2% to now 2.5%, right? And it came down fairly rapidly without unemployment necessarily going up a lot. Unemployment was at one of its lowest rates in more than 50 years, back in April of 23 at 3.4%. Now it's, as I mentioned before, at 4.1%. So it's still low by historical standards. So how is that possible, right? So I agree with you that one of the reasons was that inflation expectations were well anchored, and this way in which I described in my speech, that households and businesses make decisions, right, fed and helped us to bring inflation down even more, because they were expecting inflation to come down, wage demands may be moderated, right? Even the rents have now started to moderate, right? Housing rents, and certainly those prices have been declining. There were other reasons as well, I would say, including supply shocks, the ones that you mentioned. One of them, population growth through immigration, and then the other one, productivity growth. And those two also helped us greatly, right, to achieve this inflation while keeping a very healthy pace of economic activity and employment. So I would say, I can speak for myself always, as you know, as this goes, we don't speak for all of the FOMC. I particularly pay attention to this and what may be coming ahead and what may be different in front of us. And whether there may be, as you mentioned, a sacrifice ratio, right? Where we may be in a situation where we're already seeing some upside risk to inflation and some real increases in inflation, at least in some categories. But we may be seeing down the road a little bit of a slowdown as well. I think, as I view it, we're certainly not in an stagflationary environment.
Not yet.
No, we're not. We ended up the year very well, but we're paying close attention about how much will that slowdown be, how much will those upside risks to inflation be realized. Now, stagflation is a big word, right? It means really corrosive inflation, right? And it means that you have negative economic activity, you have a recession. And I don't know if that's really the baseline scenario to be considering, but I'm certainly paying attention to both. And we will have to consider one at a time. Right now, I see more upside risks to inflation. I see some signs of a potential slowdown down the road, but as I mentioned before, there's front loading still happening, and it may take more time for the real economy to respond to those tariffs. So I think that may be something that we may be facing ahead of us.
I'm gonna take a few questions at a time, so I'll start with you, Mark, if I can get to you, sorry.
Do you think you have a
Chairs
working
in
mic?
today, but let's see if it works.
Hi,
Yeah, maybe.
I'm Oren. I'm a junior here at Princeton. Professor Blinder has mentioned in our central banking class the cacophony problem, where it might be hard for markets or consumers to get a message from a central bank if too many people are talking. How do you go about writing a speech like this to avoid that problem and ensure that markets and consumers can understand the messaging of the central bank and the outlook of the economy in the future?
Okay, do we have a few, I'm gonna, if I can, take a few more just because I
You could hear the question.
Yes, absolutely.
I'll go to Carolyn and then I'm just gonna collect a few, is that okay?
I like that. Okay.
See if it
Hi,
works.
I'm Carolyn
No,
Wilkins,
it's not
Princeton
working.
University.
Speak up, Carolyn, I don't know.
I-
And I'm gonna
okay.
Can I get another mic?
So it's interesting to hear this talk about expectations. It was fantastic. I just kind of roll back to pre-COVID. The worry was about expectations, but on the other side, given that the average inflation in the U.S. was about 1.7%, and the framework was changed to have an asymmetric response to inflation because of that. And I'm just wondering, given the experience of the last few years and the worries more about inflation expectations on the upside, in your mind, does that have any implications for the framework review and thinking about the makeup strategies that are embedded in the current framework?
You might want to paraphrase that question a little because I don't think it could be heard. But it's a good question.
Any other student or? Yeah, Pat on the back. I'll wait for more students. Alright, Meg, you're gonna speak up because I don't think it's working.
I'll stand up first. and shout.
Nah.
What is your or the Fed's expectation for healthcare cost rising because of two things? One is the very, very busy activities of private equity, and before that, venture capital. And the other one is the mergers and acquisitions of healthcare systems. The net result of these two things happening has been to drive up costs, okay? By in many cases by as much as between 40 to 50%. And healthcare is the biggest sector in our economy. So, the activities by venture capital and private equity and mergers, they should have an impact. So what is your expectations in terms of inflation?
Do you want to take one more or answer those three and then?
Yeah, let's take one more and then I'll answer them.
Not that this is necessarily going to do you any good, but. Hi, I'm Nicole Kramer, and I'm a community member and in investment management. It was interesting to hear that you look at the soft data for inflation, and I actually wonder if the soft data is more accurate than what BLS and the Census Bureau is releasing. I actually worked at BLS producing some of the numbers years ago, and one thing that I find is that at least back then, there was a tendency for respondents to just check off unchanged. So a bias downwards. So then the other issue that comes up with the Trump administration is, can you still rely on that data and will it be impacted by politics? So I guess my broader question is, will you continue to rely on the hard data rather than soft data?
Okay, great question. So let me start with yours, Nicole, since we can maybe walk our way back. So, as I said, I think eventually in some categories, right, and we're seeing this in terms of inflation, the two converge. And one kind of gives you a pretty good leading to what's gonna come into the hard data. So I wouldn't say that one is necessarily more accurate than another. In fact, a lot of what happens, and maybe we coincided. I was chief economist at the Department of Labor and worked closely with BLS back in 2011. So maybe we coincided there. But I was always very impressed in how careful they were in collecting the data, cleaning the data, right? And it's representative of the population. That's not necessarily true of the private data. I think the private data is very timely, it's very rich, right? It can be collected with high frequency, but it's not clean in the same way. As you know, that was very hard work, right? What the BLS does is very hard work. As to what may happen to statistical agencies, I don't know much, but I would say as long as it's available, I will continue to use both. And by the same token, something that we learned from the pandemic, and this was incredible what the staff at the Fed did throughout the system, is collect all this data that was not available at the time from the statistical agency because they couldn't operate. And so these other sources of data started being incorporated. So we're doing both. I don't think it's an either or question. I guess that's the way I see it. I think they're both helpful and I think they're both informative and they come at different frequencies and they cover different issues. So I think we should continue to use both for as long as we can. In terms of healthcare prices, I would say healthcare prices have definitely been a focus for us for some time, especially when services inflation was still very high. And that was these market-based and non-market-based services, right? Healthcare kind of falls within that category. Services inflation was pretty stubborn there for a while. And there's a lot going on in the healthcare sector, but one of the main sources of those price increases was the shortages even in nurses and the shortages in healthcare workers. So there are different reasons. We watch very closely that sector because we know it does, and it has in the past contributed. As I mentioned, more recently we have seen definitely a decline in services inflation, which has helped us, except for the more recent reversal where we saw this increase from 3.1 to 3.5% in market services. Non-market services remain high. So we certainly look at every single component, and healthcare has been a focus for us in the past. So for Caroline or Caroline? Caroline. So the question was about our framework and about inflation expectations playing in now the way they are versus the way they were playing in back during the two recessions, the global financial crisis and the pandemic, when we had, or the Fed at the time, had the issue of facing fairly low inflation, right? Having a bit of a deflationary episode there, and where the issue was about not slowing the economy so much. So for me, the framework, the key to our conversations, we're having conversations right now about the framework. We are considering starting in January and in the last meeting and moving forward until the summer, we will be considering different topics that we care about in the framework, and there's going to be a conference, and there are different activities, but we're talking to each other. We haven't come to any conclusions. The key here is that we need to have a framework that doesn't focus on one particular episode, that doesn't focus on one particular situation in the economy. We need to have a framework that is resilient and that can help us move forward in terms of considering many potential situations that we face moving forward. No one could have seen that pandemic coming, or maybe some did, but the epidemiologists, the people who know about this, but certainly we need to make it as resilient as possible, in the sense that we cannot focus just on the zero lower bound issue, on having a deflationary situation, on having a flat Phillips curve, right? Now we're, as you said, right, post-pandemic, we've had high inflation, a bout of inflation. We are in this steep part of the Phillips curve. We're certainly not worried about being close to the zero lower bound, right? So we need to consider all potential situations and economic conditions moving forward and be prepared to face those. And that, I think we have been good that way, and we will definitely move forward in our conversations. And then the cacophony problem. So I'd never
I
heard
didn't
of
ask
it.
you the question.
I've never heard of it, but I think what I can tell you is, obviously the chair is a key person in sending a message to the public, but there are 19 members of the FOMC and there are 12 voting members. So that means that there is a diversity of opinions within the FOMC. And it's important to understand how different people look at the economy within the FOMC, the policymakers. I would say, how do I deal with this issue, right? I talk to my colleagues at the board all the time, right? We all sit next to each other in a hallway, and we literally talk all the time. I meet weekly or bi-weekly with each of them one-on-one, but I talk to them all the time. I talked to all the presidents during the intermeeting period to understand their view of the economy, for me to explain my view of the economy, right? It's an interaction where we're continuously potentially influencing each other's views, but it doesn't mean that we're necessarily going to agree on everything. I think that robust conversation is very critical, is what makes our decisions better, right? We don't necessarily have to agree on everything. At the end, interestingly, right, for the most part, we come to a consensus, but it's the result of those conversations. It's not we come to that situation precisely because we had the opportunity to talk to each other, to understand each other's views, to maybe move yourself or move someone else's point of view. And then we all feel comfortable, usually, with the decision we're making at the FOMC. So you don't usually see too many dissents because of that, I think. Because we are having those robust and important conversations ahead of getting into the meeting. And even at the meeting itself, believe me, we lock ourselves in for 2 days in a row in a dark room, and we're going back and forth vigorously, right? Talking to each other and figuring out why someone thinks that way or another, and figuring out where we stand. So I think it's healthy. I don't think it's unhealthy at all. I think it's important. Now, it's true, you don't want to confuse the public, but as long as you explain where you come from and why you have that position, I think you're not necessarily confusing the public, right? When the FOMC decision gets made, it's only the chair that comes out in that press conference, and he sends a clear message on behalf of all of us. And I think it is helpful.
Well, thank you very much. The next time I see Jay Powell, I'm going to tell him to get the lights on in the FOMC. I shouldn't be in the dark.
The lights are on, but all, right, just like you guys here. We put down the lights. It's very private, so.
Thank you very much.
Thank you.